So grab your headphones, let the journey start. With Suzy's Vegas tales, she's stealing the heart. In the city of dreams, let's laugh and play. Suzy's Las Vegas podcast, come join the sway.
Well, hello there. I've got a wonderful show for you today, and I know you're going to want to tune in. You'll probably want to tape this and save it, so be sure to like, subscribe, and share. My guest for today is a mortgage broker, and he's got one hell of a story to tell. And with further ado, I bring you Rey. Hi, Rey. How are you?
I'm great, and thank you for having me. I appreciate the opportunity to be here.
Well, I'm happy to have you. You know, first question. Okay, what is a mortgage broker?
Well, so I'm actually more defined as a mortgage lender. The company that I work for, American Pacific Mortgage, I'm a regional manager for that company.
Okay.
We are a mortgage bank. And so when you're a mortgage bank, you lend your own money to people.
Okay.
And then you can still choose to sell those loans to, like Fannie Mae, Freddie Mac. But we also have a broker opportunity too, so we can broker loans to other lenders as well.
Oh, wow.
So we kind of have a mix. Yeah, it's really a good mix at American Pacific Mortgage. And there's a lot of opportunity for different types of mortgages. Mm-hmm. A mortgage broker, mortgage lender, it doesn't really matter what you want to call us. We do mortgages.
You wear different hats,
Yeah,
but you do it all.
Correct.
So in other words, like when you're looking at your clients, you're able to put the right fit with the right person.
Absolutely. So, we after the mortgage crash, we became fiduciaries, which means that we have to put our clients in the best mortgage possible for them.
Amen.
And rightfully it should be that way, right?
Yeah.
And so the nice part about working at American Pacific Mortgage is, if our bank product is the best for them, then we do that. But if there's another option for them from a broker perspective, we can move them over into that and get them into the best loan possible.
Wow.
Yeah, it's really worked out for us. And American Pacific does a really good job of allowing us to kind of be flexible when it comes to that.
Well, how many people work at American Pacific? It's a big company.
Oh yeah,
isn't it?
I mean, we in 2024 we were the 10th largest mortgage company in the nation. So there's a lot. I'm not even sure how many employees that are employed, but it's got to be in the probably 3,000 range, something like that.
So when you do mortgage, is it just Las Vegas or is it other states also?
Well, my direct team, team does Nevada, Texas, Arizona, California, Colorado.
Oh, so you have the whole group?
Yeah, and so, but we also indirectly can do the entire nation.
Wow.
Yeah, and so some mortgages will allow you to do loans in other states, some types of mortgages.
Yeah.
But also we have an indirect team that's licensed in every state, so we're
that's great. That's
entire
wonderful.
country pretty much.
Wow.
Yeah.
Well, that leads me to another question. You're not from here, correct?
I'm not. I'm originally from New Mexico.
Okay.
Came out here. I'm from Albuquerque.
Yay, Albuquerque. Hi, Charlie. We have another one.
From Albuquerque, went to college at New Mexico State University, which is down in Las Cruces in New Mexico, which is about 3 hours south. Yeah. And then, in the final year of college, came out here for spring break, looked at the paper. We're looking at jobs, looking at rent. I'm like, wow. This makes a lot of sense. So me and my roommate at the time decided to move out here after college. So
wow.
Been here. So that was in 1996. So been out here since then.
So you were 4 years old then, huh?
Yeah. Right. I wish. Yeah.
Well, you're still young. You got a long way to go.
Hopefully. Hopefully.
For sure. Well, what does what does it look like in a day in your world, or say a week, Ray? You have other jobs besides mortgage broker. You do continuing education, I believe?
I do, yeah, and I wouldn't consider that another job because I do it as part of my function for generating business for the mortgage, the mortgage space. I'm a certified instructor with the Nevada Real Estate Division, and I teach continuing education classes for real estate agents. And all of the classes I teach are mortgage centric. So basically what I'm teaching them is about mortgages, right?
Okay.
And in those classes, I'm not trying to teach them how to be a loan officer, because if they wanted to be a loan officer, they'd have a loan officer license, right?
Sure.
But in a real estate transaction, the real estate agent is the quarterback of the transaction,
Sure.
right? So when someone thinks about, hey, I want to buy a house,
Yeah.
they don't sit there and go, oh, I need an appraiser, or I need a title agent, or I need to go get pre-approved with a lender.
Correct.
They think, I want a real estate agent.
Sure.
So inevitably they're going to be asked mortgage questions. So the goal of my classes is to make sure that when they get those questions asked, they can answer them with some intelligence, but then they always want to refer them back to the lender, right? So for example,
absolutely.
I look at tax returns all day, every day. I know
Yeah.
when a tax return has been done right, when it's been done wrong, where to identify certain things in a tax return, because that's been my entire career, right?
Yeah.
But I'm not a CPA. So what I say when I talk to people about the tax returns is I say, well, from my chair, okay, this is what I see.
Okay.
But consult with your CPA.
Yeah.
And that's the goal of my CE classes, is so the real estate agents, instead of just saying, well, I talk to your lender about it, right?
Right.
They say, okay, well, from my chair, this is what I know about the mortgage question you're asking me.
Yeah.
But consult with your lender as well. And so that's kind of what we're going for with those classes that I teach. I've been doing it for 9 years now.
Wow.
Well,
they're important.
It's a good way to...
Yeah, they're very important.
Yeah.
That way they have answers.
Yeah,
When people
it really
ask
is.
the questions,
Yeah.
yeah.
Well, the real estate agent's the quarterback, right?
Yeah.
And they're expected to know what
Everything.
every person on the team is doing, right?
Right.
And so, so that's the goal of those. And we've had a very good reception of those classes that we've been teaching for the last 9 years. So,
Well, I'll
and I
bet.
like doing it. So
Well, there's a lot of changes, isn't there, every year?
every single year. And I would say since COVID, aside from after the mortgage crash, post-COVID, we've seen the most changes in lending.
So, give me an example if you could.
So, for example, so self-employed borrowers, right? Okay, so
Okay.
when we look at income for a borrower to qualify them, on traditional financing, there's basically two types of borrowers. There's what we call W-2 wage earners, okay,
Right.
which means you work for a company you have no ownership interest in. Okay, so let's say you work for Caesars Entertainment,
Correct.
and you make a salary of $120,000 a year.
Okay.
Well, we calculate it by month, and so we would give you your gross income, which would be $10,000 a month. Okay.
Right.
The second type of borrower that we look at is self-employed. Self-employed borrowers, we have to start with the net income, which we know it's different, right? We see the gross
I've been
receipts come in.
self-employed my whole life.
So you
I
know.
love him on the show, folks. I really do. Now we're cooking.
So you know the difference between what you actually
yeah.
bring in and what you report to the
Yeah.
IRS. Per IRS regulations, they let you take expenses, rightful expenses, and reductions.
Yeah.
So self-employed borrowers have been at a disadvantage when it
Correct.
comes to traditional financing, always.
Yeah.
When COVID happened, there was some additional restrictions put in by the agencies. And when I say agencies, I'm talking about Fannie Mae, Freddie Mac, FHA, VA. Okay, so
Right.
the traditional financing.
Absolutely. Yeah.
They put some additional restrictions in place for self-employed borrowers.
Yeah.
And it made it even harder for them
Oh,
to
yeah.
qualify. And so, those were the biggest changes that we were seeing, is that, our self-employed borrowers that came to us, we couldn't qualify them for as much, or maybe they didn't qualify at all.
Right.
And so there's been a lot of changes. And the thing that's a little bit more frustrating is they called them temporary.
What?
Yeah, they said they were temporary COVID restrictions, right? They haven't let them go
But
yet.
oh my God, COVID was when?
It's been a minute since.
Let me think
COVID,
about this.
And so it's just it actually led to a massive surge in what we call non-QM financing.
Yeah.
So these are some additional types of loan programs that we don't have to use traditional means to qualify. Non-QM loans have been around for, I don't know, probably 10 years, 12 years, but they represented probably up until 2024 about 1% to 2% of the total loan volume that was out there.
Really?
In 2024, it represented 14%. So I mean, massive jump in these non-QM financing.
Yeah.
And so again, lucky that I'm at American Pacific Mortgage, because they really have embraced the non-QM financing.
Oh, that's wonderful.
And these are loans that you can qualify through different means. For example, like instead of using your tax returns, if you're self-employed, you can use your 1099.
Okay.
Or instead of using your tax returns, you can use bank statement
There
deposits.
You go. That's what I do.
That's okay. So
yeah,
you're
I
familiar
understand
with
that. But yeah, see, I'm glad we're talking about
yeah.
this, because there's a lot of people asking the same questions.
Yeah. How can I qualify if I'm self-employed?
Exactly.
Or even if you're not self-employed, the most popular non-QM loan right now is called a DSCR loan. DSCR.
Okay.
Debt Service Coverage Ratio.
Okay.
Okay. So forever, if you wanted to get a commercial loan, they don't necessarily look at your personal income and debts. They look at, can the property sustain itself with the rents it's going to bring in?
Right.
And that's how they've done commercial financing. Well, with this DSCR loan, they kind of overlaid that onto residential property.
Okay.
So now, and we're doing a bunch of these. I mean,
I'll bet,
because it's for investment properties only.
Yeah.
Okay? And so what we look at when we do an investment property appraisal, we do an appraisal plus what's called rental comps and analysis.
Right.
So the appraiser goes out in the area, finds like property that's being rented, sees what it's being rented for, and then gives kind of an anticipated rental income number that they think that property can bring in. So we use that and compare it to the subject property housing payment. And when I say that, it's everything that comes with it, right? It's principal, interest, property tax costs, homeowners insurance costs, if there's a homeowners association fee, master plan fee,
you put it all.
SID, LID, we calculate it out. And if the anticipated rental income is equivalent or more than the subject property rental payment, or the subject property housing payment, then the loan qualifies. Wow. We don't look at the personal income. We don't look at the personal debt.
Yeah. Yeah.
We don't look at personal income. We don't look at personal debt.
Yeah.
We just, if the property can sustain itself, it's good, and we can qualify that loan. And people that are very interested in building wealth,
absolutely,
investing in real estate, they are scooping these up as fast as they can.
Well, yeah,
because there's a lot of flexibility.
See, I didn't know that, Ray,
Yeah.
and I'm tickled to death that you're on my show today, because you said DSCR.
DSCR is the loan program that it is, and it's got a lot of flexibility too. So, like for instance, Fannie Mae, if you're doing a Fannie Mae loan and you're buying an investment property,
right?
Okay. The maximum number of finance properties you can own per their guidelines is 10. So if you have 15 properties and you want to buy 5 more, you need to find a different type of loan, right? And so that's where these DSCR loans come in. These investors are just scooping them up as quickly as they can.
My God, I didn't know that was out there.
Yeah, it's there. And, it's very flexible when it comes to like LLCs. So when investors buy properties, a lot of times they'll put them in an LLC to protect themselves, just in case there's, whatever, slip and fall or whatever it might be. This program will allow them to keep the property in an LLC or take title in an LLC's name without having to put in their name first.
Really?
Now, they still have to, the loan will still be in their name, but the title, which is where the protection is can be in the LLC's name. It's a very flexible program, and we have just a lot of opportunity for it. I mean,
well, in Vegas, this must be just all over. I mean, everybody has to be really scooping us up.
Well, when they know about it.
Yeah.
But
well,
they don't
see,
know
I
about
didn't
it.
know about it. That's why I'm glad you're on my show today.
And that's the thing is they don't know.
No.
People don't know that this can be done. For example, right before I came here, I got a call from a gentleman that has an ITIN number. But he has an investment property that he wants to refinance.
Yeah.
And he asked me about it, and I said, yeah, we can do it with an ITIN number.
You can?
Yeah, it's flexible. You can do it foreign national, ITIN. We can do it, obviously, if you're a U.S. citizen, but
sure.
The flexibility of that program is why that number went from 1% to 2% to 14%.
Oh, yeah.
It's a very good program.
Yeah.
Luckily, 6, 7, 8 years ago when it first started coming out, I was intrigued, so I started learning about it. You know what I mean?
Well, I'm intrigued.
So now at this point,
Let me tell you, I am really intrigued with this.
Yeah, I mean, investors love these loans because they're just so easy to execute for them.
Wow.
And paperwork is, not nearly like it would be if they, had 8 or 9 properties with the Fannie Mae loan or something like that.
Well,
so
sure.
We're doing a lot of them.
Yeah. Well, Ray, if you get a new customer coming in, walk me through some of the things you're going to ask that customer.
Yeah.
Will?
So things have kind of changed, right? So 10, 12 years ago, customer call, or let's say, so a lot of my customers come from real estate agents, right? So the real estate agent calls and says, hey, I got a client to refer you. 10, 12 years ago, I'd call the client, they'd come in, we'd sit down and we'd do a loan application, and then we would get them pre-approved. Well, it's all changed now because people want to do everything electronically.
How has it changed?
They want to do everything electronically.
Oh,
so
most
now,
people do.
I give them a call, and I have a team that does the loans that I bring in. Okay, so because of the way I get paid, and the way I manage the region, I'm not the one that sits down and does a loan application. I have a team that does that, but I still like to be the one that talks to them initially.
Yeah.
I call it my warm and fuzzy call, right?
Yeah.
And so, I talk to them, ask them questions. Because if someone doesn't have a job, what's the point in doing a loan application?
No, let's not try that.
Yeah, so I do my warm and fuzzy, kind of a pre-qualified call, answer any questions, explain the dynamic of my team so that they understand if someone calls you, on my behalf, they're calling on my behalf. And but now we send them an application link. So they can do it on their phone or on their computer. It asks them all the proper application questions.
Okay.
Then it also gives them a secure environment to upload their documents, because it used to be, that's a big deal now.
No
you know what
kidding.
I mean? With all of the identity theft and just
it's
that
just
kind of stuff.
Every day it's different.
Scary. And so, we as a mortgage, think about the information we have as a mortgage company. We have it all, right? And so we've had to adapt to a very secure environment, which is good, right?
Yeah.
It's absolutely a good thing. And so they can upload their documents in that secure environment. And then the way we do the pre-approval process is, we pull their credit report. We do some analysis on their income versus their debts.
Right.
We look at their assets. Do they have enough money for a down payment? If we need reserves, do they have it? And then at that point, if it looks good, we'll issue a pre-approval letter and some detailed written estimates that outline estimated rates, fees, monthly payment, cash due at closing, everything. So that way,
you do it all before they.
We do it all before. Because why would you go get in a car and fall in love with a house?
No.
Only to understand that you don't want to pay that payment.
Yeah.
You might qualify for it.
Yeah.
But once someone falls in love with a house that they technically don't want to afford, they might qualify, but maybe the payment's just going to be too high for them.
Right.
Everything else is going to pale in comparison.
You're right.
And so we want to make sure they know what to expect. And we do this for our real estate agents also. It's like, I don't want to waste your gas.
No.
I don't want to waste, I don't want to do that. I don't want to waste your time or gas.
No.
If these people are going to go look at houses that they just don't want to afford.
Yeah.
You know what I mean? And so that's kind of how the process works nowadays. And we always offer, do you want to come into the office?
Yeah.
Do you want to do a phone
9
application?
9 times out of 10, you're going to say they want to do
the convenience.
Sure.
They want to click on their phone. They
Yeah.
can do it while they're watching TV.
Yeah.
You know what I mean? And
Yeah.
so things have changed quite a bit.
Yeah.
But
But it's good for both, really.
It really is.
And it
Well,
saves
I mean,
time. And,
we
Yeah.
can do more now because we have more time.
Right.
You know, plus nowadays, we used to have here in Vegas, we used to have 3 large spaces that we would rent, but nobody goes into the office anymore.
Most
After
of them
COVID,
work out of their home.
yeah, after COVID. So,
Yeah.
so that saves on costs and
Right.
stuff like that
So
as
you
well.
can keep it low and tight.
Yep.
Yeah.
Which provides better margins to the client, which means we can provide better rates.
True.
So
So what do you see going forward? Right.
man, I wish I had that crystal ball, right?
Well, just as an idea, you know, I'm sure everybody, be sure to like, subscribe, and share. This is one hell of a show you should keep. DSCR, finding out all about how to fill out the paperwork.
Yep.
I mean, please.
Yeah.
Thumbs up, babe.
I'm with you. So going forward, so luckily since January, rates have been coming down because that's what everybody asks.
Oh, yeah.
Where are rates going to be, right? One of the most important things that I think people need to understand, and this is very, very important, is the Fed does not have control over mortgage rates.
What?
They don't.
Okay.
We
learned 2 things today.
The Fed controls what's called the Fed funds rate.
Okay.
That's the rate that banks borrow money from each other to cover their overnight reserve requirements.
Okay.
It has nothing to do with mortgage rates. There are times when a Fed rate cut will correlate with mortgage rates going down, but there's also time where it's inverse. I'll give you an example.
Yeah.
In September of last year, the Fed cut the Fed funds rate by 50 basis points. Mortgage rates spiked up after that. So it does not correlate.
No.
And a lot of times, I'll have agents that say, oh, well, my client wants to wait because they think the Fed's going to cut the rate. I'm like, they're not cutting mortgage rates. So I don't know what you don't want them to, quite understand that.
Yeah.
And so, rates since January have been coming down, which is good. Hopefully they will continue to come down, and I feel like they will because the environment that is going on is actually good for mortgage rates. So we get our rates from the mortgage-backed securities market.
Oh, you do?
Yeah, that's where rates come from.
Mortgage-backed securities.
Mortgage-backed securities market, yeah.
Okay.
It's not a public market.
You heard that here.
So you can't jump online and see where that is. We have systems that we have to buy that will show us what is going on with those.
Okay.
And so, but that's where we get the mortgage rates from. Things have been going in a good direction for us since January. They were a little wobbly, all last year because nobody quite knew what was going to happen, and so that's always in an election year. Regardless of what the scenario is, they're always wobbly.
Well, sure.
But so far this year they've gone down about 65 basis points, which is basically equivalent to 0.65%.
Okay.
In rate. So they're going in a good direction. Now, as far as the housing market goes.
What, like today, what is the rate?
So 15 years ago, I could tell you what the rate was.
Okay.
But since then, the entities that, buy mortgages, Fannie Mae, Freddie Mac, FHA, VA, and FHA insures them, VA guarantees them. They have put they're called loan level pricing adjustments in.
Okay.
And so your rate versus the next person over are going to be 2 different things.
Because of what? Your credit score?
Credit score, down payment, number of reserves, not age. We can't do that.
Okay.
But just there's a lot of variables. If it's a condo, if it's a townhouse, all these things cost more money.
They all go in.
Yeah, and so you have these adjustments. So I can't really quote
a condo costs more than a regular rate for a house.
Yeah. It does.
A point, 2 points?
It's tough to say. Again, it's because there's a lot of variables.
Okay.
But it's definitely an increase. Townhouses aren't as much. Condos are. But you know, because of all these adjustments, when someone says what's your rate, I can't quote a rate because your rate might be different than my rate, you know, and so plus it depends on the lender. It depends on how much the lender's packing in the for their income and stuff like that. But I can give you a generalization right now. So Freddie Mac, whom I'm sure you know that entity. Okay, so they put out what's called a primary mortgage market survey, and that basically does an analysis on all owner-occupied 20% down purchases for that week that were locked on Freddie Mac loans.
Okay.
And so as of this week, that rate's at 6.65.
Okay.
Doesn't mean you're going to get that. You might get a little better, right?
Yeah.
If you want to pay points, if your credit score is better, that's the average of what people locked on Freddie Mac loans this week. So, so that's about where it's at. That was at 7.79 in October of 23.
Really?
That's how high it got.
Wow.
Yeah. So we've gone in a good direction since then, and hopefully they'll continue to go in a positive direction, and we'll see. But the lower rates get, I think what we'll start seeing also is some more inventory coming into the Vegas market specifically.
I think so.
Because 62% of all currently mortgaged homeowners have a rate of 4% or more, or less, I should say.
Yeah, ours is real low.
Yeah. So if you were going to move, not only are you going to pay more because we know prices have gone up dramatically, but you're also going to close to double your interest rate.
Yeah, I know.
So why would you do it?
Right. No, I'm
most
happy
people
where I am.
Yeah, most people don't buy a house and then rent out the previous one. They buy and sell.
Yeah.
Right. And so, unless you have to, why would you? You're just going to double your payment. I mean, for no reason, right?
Yeah, crazy.
And so, the inventory's kind of a problem because that keeps pushing prices up because there's not a lot of inventory. So it's a seller's market,
Yeah, sure is.
And so, if we can get those rates down even close to 4, I think we'll see some inventory loosen up, which can help prices maybe ease up a little bit, and we can see some more, turnover. But most of the transactions we're doing right now are need-based, right? So, maybe they're getting married, maybe they're getting divorced, unfortunately, relocations, stuff
California,
like that.
a lot of people coming out here.
And,
with all the mess over there.
And they love our prices.
Oh, yeah. Big difference
they
between
love our prices. They're like, I can get this for that. Oh, yeah.
Yeah.
So it's interesting. So I guess the original question was, what do I see going forward?
Yeah.
Well, that's what we're dealing with, and so until some of those things kind of rectify themselves, I think that we're gonna still see a sluggish market, I should say, but a sluggish Las Vegas market is probably a boom market in most other cities.
Oh, yeah.
We've always been a very, very good market for real estate. I mean, we're just growing so fast.
Sure. Yeah. So many people.
Yeah.
So many things going on.
Yeah. Mm-hmm.
I got to tell you, this time went so fast with you and I. And what I would like to do is I'd like to have you back on again.
Absolutely.
And we'll talk about the next step in your process here, because this is really something I'm into, and I know all of the people watching are too. It's a big deal.
Well, it affects everybody.
Yes.
Every single person that's in Las Vegas is affected by real estate.
That's true.
Even if they rent. Yeah. Even if they're not homeowners. Yeah. At some point, they're probably hoping to be homeowners. Yeah. But if they're not homeowners and they just want to be renters forever, their rent is affected by the way the housing market goes.
Well, of course it is,
And I mean, rents go up because of the housing market, and it affects every single person in the city. And so, I personally love the business that I'm in. Early in my life and career, I was in the restaurant business.
Were you?
Yeah, and I hated it, but I did learn about
in Albuquerque.
No, here. When I first got to Vegas.
Okay, come on, tell us the story.
Well,
come on,
okay,
Ray.
so yes.
Can we talk? Can we talk?
In New Mexico, I was in a restaurant in college. I was a manager, a bartender, server. Got here, just grabbed a job so I could get it, and then they promoted me to a manager. And I kind of got, rooked into it, to being a manager for a little bit. Yeah. But what it taught me was customer service.
Oh, yeah.
I learned a lot about customer service, but I went to college for finance. So the combination really turned out to be the perfect thing for this business, for the mortgage business.
Absolutely.
And so when I transitioned into the mortgage business, it was a natural thing. Yeah. I don't discount myself. Oh, plus I got trained to be a chef, so I cook very well. But I do that for fun. I don't do that, yeah. So right. So that was a lot of fun, and I don't discount any of the time I spent in the restaurant business.
No.
I really liked it.
Well, you had quite a background, didn't you?
A little bit.
Yeah, for sure. Wow.
Yeah.
Well, if people want to get a hold of you, Ray, how do they do that?
Always the best way is my cell phone.
Okay. What number is that?
702-808-8328.
Okay.
Text, call, either way. That's always the best way to get a hold of me. They can also email me. But my cell phone is always going to be the best way.
Text is easy for everybody.
And I do that.
Text.
Yeah, no problem. Yeah, so.
Yeah. Well, I got to tell you, I'm tickled to death that you came on today.
Well, I'm glad. Thank you for having me. I really appreciate it.
This was fun. But we're going to do it again, and I want to find out, the latest and the greatest and what's going on.
I'm always willing.
Yeah. Well, that's our show for today. We hope you liked it. Be sure to like, subscribe, and share. And don't forget to give Ray the thumbs up here so we get him back on again and find out all the new things that are going on. This was one hell of a show. Take care. Bye.
Thank you.
So grab your headphones, let the journey start with Suzy's Vegas tales. She's stealing the heart in the city of dreams. Let's laugh and play Suzy's Las Vegas podcast. Come join us, way.